checking in no bag, shopping when we land. Big FN bag of ballin'. Plead the fifth if I get caught, they talk. Came through dripping on them, I been saucing.
Hey, what's going on, guys? Welcome back to another brand new video on this channel, and today I'm going to be going over efficient market hypothesis theory, which is the number one thing that disproves all ICT, SMC, and all retail strategies, or anything that all these technical strategies, even fundamental strategies that you've seen on YouTube as well as online and on your feed. So now, what really is efficient market hypothesis? Well, efficient market hypothesis is essentially this theory that there is no such thing as an edge in the market. We're not going to talk about psychology today, because the number one thing to even be profitable in the first place is you should have an edge, meaning a strategy that works over a long period of time. If it's impossible, right, to have a strategy that works over a long period of time, then it doesn't matter how good your psychology is over a long period of time, you'll be negative. It is why many people believe to be the reason why 9% traders lose, if not more. And the 10% that are winning are likely institutions and people that have ways to distinguish information differently, or tools and access to high frequency trading algorithms, which normal people will never get access to. So we're not gonna include those when it comes to strategies. We're talking about typical strategies that normal people like us trade, not some algorithm or sophisticated MIT algorithm that these institutions are paying people millions of dollars to make. So that's a completely different story for a whole different time. We're not going to talk about that. We're talking about the 90% of normal traders like us trying to make it, right? Or that have already made it, which you would actually be disproving the efficient market hypothesis if you already are profitable. I'm going to tell you my stance on this, right? Clearly, I'm against efficient market hypothesis. I've proven with my track record that's just not true. Otherwise, I wouldn't be profitable consistently over past 3 years. So that's why we're going to go over this efficient market hypothesis. So what this is states that there is no edge in the market, meaning no matter what strategy you're testing, it's going to be 50-50. Essentially, in terms of expected value, it'll be 0. So when you said there's no edge in the market, this then leads to the assumption that any or all strategies eventually lead to 50-50 win rate odds at 1 risk reward equivalent, which is also equivalent to 0 expected value system. Meaning, if you go from this, if you're at a 0 expected value system, you're going to be an unprofitable trader. Why? A lot of people would think that's break even, right? That is not true at all. That's on a demo account. On a real trading live environment, that is not profitable because of live spread and commissions. And trust me, those will eat you up, especially like I mentioned, over a long period of time, it will eat you up. That is the assumption of efficient market hypothesis, that there's no edge in the market. And what that assumes is all strategies back tested lead to 50-50 odds, because it has to be this way. Because let's think about it this way. If there is even a 70%, even a unprofitable system, if you reverse it, you will be profitable. I made a video talking about reversing unprofitable strategies that are very mechanical and that truly are unprofitable. You can make them very profitable. But if a trading system is 50-50, there's no such thing as unprofitable or profitable. Both are unprofitable. At 0 EV is unprofitable on both sides, no matter how you flip it. 50-50, 50-50, right? But if you have a system that has, for example, a 30% win rate at 1-to-1 risk reward, if you flip keeping the same entries, right? If you flip your stop loss where your TP is and put your TP where your stop loss is, you end up with a 70% win rate at 1-to-1 risk reward. Assuming this is over a period of time, this clearly disproves efficient market hypothesis. This shows there's a clear edge in the market at a 0.40 expected value of 70% win rate at 1-to-1 risk reward. So efficient market hypothesis is saying that every strategy eventually is a 0 EV system. You can even say over a period of a year, let's say a year, over a year, all strategies lead to 0 EV expected value in terms of statistics. Because if there is an unprofitable strategy, there is also a profitable strategy. So I hope you guys are understanding this now from this perspective. Efficient market hypothesis is stating there's literally not a profitable strategy out there that works over a long period of time, and there's also not a unprofitable strategy in terms of statistics. It just ends up being unprofitable because of spreading commissions, not because of the numbers. So now you guys understand this. This is what efficient market hypothesis is, and this clearly goes against ICT and SMC. This clearly goes against ICT and SMC because ICT himself states that or believes that the market has inefficiencies. And for these inefficiencies, we're going to assume inefficiencies that retail traders can handle, not algorithms that are trading on the 1 second time frame, right? Or trading ticks that retail traders or normal traders can actually take advantage of and expose. And that would be your strategy. Your strategy, every trading strategy is essentially exposing some sort of inefficiency within the market. That's really what a trading strategy is. You're trading and believing that the price that you're buying at is low enough to go back up to what you tend to believe is fair value price. So you believe that we're going from inefficient pricing to efficient pricing. So from unfair price to now a fair price. That's what you're trading. So you're either buying low or selling high. But in a fully efficient market, there's no such thing as buying low or selling high, because everything priced at that time is already factoring all the data and economic data, technicals, it's factoring everything in the market is how it is perfectly. So essentially, efficient market hypothesis is also stating that the market is perfect by itself. Every single second of the market is perfect, and there's no inefficiencies to sabotage. Because if there are inefficiencies, there will be a working strategy. And there also will be a not working strategy that exists as well, which you can just reverse. So hope you guys can see and understand now what I'm getting at here. So putting these puzzle pieces together, there is 3 stages of efficient market hypothesis. First one is the weak stage. So for the weak stage or weak form, this assumes that all market activity or pricing currently is already factoring in live technicals. So what this is saying is there's no such thing as taking advantage of inefficiencies based on technicals, basically any strategy. Basically what everyone here watching is trading, almost majority of traders are trading off technicals, and especially day traders are going to be trading off technicals. I doubt you're going to be day trading or scalping off fundamentals. It just doesn't make sense. That's not how fundamentals work. They're not going to change how price moves on the 5 second or 1 minute chart just based off fundamentals. So all market activity and pricing currently is already factoring in live technicals. What this means is that there exists no profitable technical strategy or edge. Now there's also next form would be semi-strong. And what semi-strong is, it's assuming that basically fundamentals. So semi-strong is factoring in fundamentals. So it's stating fundamentals are already factored in at current live pricing in the market. Meaning there exists no fundamental strategy or info out there that will give you an edge over a long period of time. So that's semi-strong form. Now, what is strong form? Which is what most people that do believe in efficient market hypothesis actually believe in. They believe that strong form, which means both fundamentals and technicals, are already factored in at live market pricing. Therefore, no inefficiencies exist and no edge exists. Therefore, there is no edge over a long period of time based off fundamentals nor technicals or any type of strategy. There's no way you can have an edge over the market at all. Now, the only thing I guess you could say that disproves this would be like if you were to invest in ETFs, like SPY, for example. That's always going to be up, right? It's always going to go up at some point annually, right? Your equity curve is going to be around like an 8 to 10% annual return every single year on average, just based on historical data. But aside from that, aside from basically long-term ETFs and a few other things, there's no strategy, there's no fundamental strategy or technical strategy. That's why a lot of people also like investing long-term, because you're almost guaranteed a safety blanket if you're investing in these huge indexes. So there was 3 stages, EMH, and now after watching this video, you guys should understand what efficient market hypothesis is and why this basically goes completely against ICT and SMC or any types of retail strategies, because it's stating that there are no inefficiencies and that at the end of the day, everything goes to a 50-50 and 0 expected value odds, where you cannot exploit a not winning strategy and turn it into a winning strategy, and you cannot have a winning strategy either, which is also something that a lot of people need to keep in mind when it comes to psychology. And that's the main reason why I talk about this video. The main reason I mention this is because this teaches that psychology that so many people put value on does not come first. If no such profitable strategies work, whether that's fundamental or technical, then psychology means nothing. If your strategy does not work, psychology means nothing. That's what I'm trying to get to with efficient market hypothesis. I disagree with efficient market hypothesis because I'm living proof that it's not true. And so are many other traders that are doing very well in the course and community that are funded. But the reason why I bring this up is because people need to understand that psychology does not come first when it comes to trading. Because let's say efficient market hypothesis is true. Let's say it is true. Or let's say you're someone that believes it's true. Then why struggle so much with focusing on your psychology? Why struggle so much on building all these good habits in life, in your psychology, and thinking they will translate to a chart, saying things like fear and greed? I don't like these words, fear and greed. Why? Because they don't help when it comes to making technical decisions on the chart. I'm not thinking about fear and greed when I put my TP really far or really close. That's just based on data collection as well as my past experience of how good my TP and stop loss placements are. So the main gist of today's video really is focus on your strategy. Make sure you have a truly working strategy first, then focus on your psychology, because then that's the rest of the equation. Strategy plus psychology equals profitability. But again, if you don't have a working strategy, or if EMH is true, for instance, which is the same thing as you don't have a working strategy, not working strategy, that's basically what I'm basically using EMH as a way to put an equivalency to a not profitable strategy, because there are strategies that literally are not profitable. 30% win rate at 1-to-1, right? Then no matter how hard you're trying in your psychology, it doesn't matter. Nothing's gonna change, right? Nothing's gonna change until you find something that genuinely works over a long period of time in the market. That's why some people, right, what they do is they pass challenges, fund accounts, and then they immediately blow the account, or they get one payout and then they never see consistency in that account where they continuously get payout, or several payouts, or even maintain that account for a very long period of time, let's say like 90 days. It's because they probably got lucky in the sequence, right, of wins or risk reward. But remember, efficient market hypothesis is stating that at some point this will average out to 50%. And so they just got lucky that while they were trading those funded accounts and getting those payouts, they were within the winning sequence and they missed out on the losing sequence. So some people generally trade like that, and that's why they can't trade with live accounts, because they don't actually have a long-term profitable edge. They just have something that they got lucky at that worked, luckily, in terms of the sequence of wins. Or they over leveraged maybe on like 2 trades that turn out to be the 2 winners, but then they later face all those losses because their strategy doesn't work and it's going towards 50-50 odds or even worse, and that's why they don't get the payout ever. So I'm hoping you guys, after watching this video, will understand truly better on efficient market hypothesis and how I'm using this to help you guys build this foundation to understand that you want to focus on, make sure you understand the technicals of the chart or fundamentals, whatever strategy you're using. I have a course in mentorship, prime mentorship. Prices are going up right now, by the way. So they've already gone up, by the way, from what it was originally. It's already going up, and it will only go up from here the more members that join. So I'm trying to make it as exclusive as possible, and at some point I will close it and probably never sell it ever again. So again, if you guys are interested, you click the link in my bio, essentialtradersuniversity.com, to check out the pricing and what I have to offer for you guys. And feel free to take a screenshot of this video, and I'll see you guys in the next one.